two families on the same street, both retired the same year, both had about 1.5 million. 15 years later, one of them has 2.4 million, which is 5 times more than the other. Same market, same crashes, same starting point. The one who came out ahead didn't pick better stocks, and they didn't get lucky. They made one decision before they retired. And if you're within 10 years of retirement, you might already be this retiree without knowing it. Now, here's what I find interesting. The family with 2.4 million didn't earn it through better investments. The family with $480,000 didn't lose it through bad luck. The gap comes down to actually one decision, something most families never even think to ask until it's too late. And I've watched this unfortunately play out over 31 years. The families who get it right, usually they don't realize how big a deal it was. The ones who get it wrong, unfortunately, they spend retirement always wondering if the money's going to last, always cutting back, always anxious. My name is Chris McClure, and I've been a financial advisor for 31 years, and I put these videos together about once a week, and hopefully it's honest information for high net worth families who've worked too hard to leave money on the table. You see, there's a concept called sequence of return risk that explains why those two families ended up so far apart. And once they understand this, the 2.4 million versus the $480,000, it makes complete sense. When you're still working and saving, a bad market year, it doesn't really hurt you, right? You keep contributing, prices are lower, so your money buys more shares. And eventually the market recovers. The order that returns come in just don't matter much. It doesn't matter when you're accumulating. The minute you retire and you start pulling money out, that order, it matters a lot. If the bad years hit right when you start withdrawing, you're forced to sell shares at the worst possible moment just to pay the electric bill. The portfolio never gets a chance to rebuild. So you're pulling money out while it's trying to recover. And every year that goes on, the hole gets deeper and deeper. See, a lot of advisors, they hear this and they just say, oh, keep a year or two of cash on the side, that helps. But the 2008 recovery, when we went through the financial crisis, that recovery took about 5.5 years to recover from. The dot-com crash of like the early 2000s, that took even longer. So a cash cushion, it's helpful, but it delays the problem. It doesn't solve it. The retirees who end up 5 times richer, they actually have this solution, and it's simpler than most people expect. And real quickly, if you're watching this and you're already wondering how your own income picture stacks up, there's a link below that you can click, and I'd be happy to chat with you about your situation if you'd like. The solution to all this, it's called an income floor. It's a really simple idea. If your basic living expenses are covered by guaranteed income sources that have nothing to do with the market, you are never forced to sell. Not for 1 year, not for 5 years, not ever. So let's say the market drops 30%. Your neighbor is selling his portfolio at the worst possible moment just to cover their mortgage bill and their grocery bill. And you're not. Your Social Security covers the basics. Maybe you have a pension. Maybe you have rental income from a property that you own. Your portfolio just sits there. It rides out the storm. And when the market comes back, and historically it always has, you've got dramatically more in it than he does because you never sold at the bottom. And this is what people miss. The income floor doesn't just give you security, it gives you time. It means you're never a forced seller at the worst possible moment. And time in the market without being forced to sell, that's about the most important thing you can do in retirement. So Social Security counts, a pension counts, rental income counts, any kind of guaranteed income you might have, maybe from an annuity or a pension you created yourself. But your investment portfolio, your stock portfolio, it doesn't count because it goes down when the market goes down. And that's exactly the problem we're trying to solve. So ask yourself this, if your portfolio dropped 40% tomorrow and stayed there for 3 years, could you cover your basic living expenses without touching it? If the answer is yes, you're that retiree that's 5 times richer than you think. If the answer is no, I think that gap is worth closing before you retire or even if you're in retirement. Now, let me go back to those two families that we were talking about that lived on the same street. Margaret and Bill retired in early 2007. Margaret had spent 28 years as a registered nurse. Bill had worked in manufacturing and he had a small pension, about $14,000 a year or so. They also waited long enough on Social Security that their combined benefit came to about $52,000 a year. If you add up the pension and Social Security, it's $66,000 of their $78,000 in annual expenses, guaranteed. And it had nothing to do with the market. Their portfolio only needed to generate about $12,000 a year. That's it. So when 2008 hit and their account dropped from $1.5 million down to $870,000, they didn't panic. They didn't have to sell a single share. Their income covered everything. The portfolio, for the most part, just sat there through the worst of it and rode the recovery right back up. By 2022, 15 years later, their portfolio had grown to 2.4 million. They started with $1.5 million and ended up with more. And they went through 2008, they went through COVID, they went through all of it. It didn't have to be complicated. We just set it up right. Now, Dennis and Carol, they were on the same street. They retired on the same year, and they had about $1.5 million saved, so almost the same amount. Dennis had worked in a corporate job for 30 years, and Carol had done bookkeeping for a small manufacturing company. And they were happy with what they built, and they should have been. Years later, after they retired, they were referred to me, and I had to sit down with them. And I found out that Dennis had claimed Social Security at 62. I understand why. He paid into it his whole life, and he wanted the money. And so claiming early, unfortunately, it reduced his benefit by about 28%. And Carol claimed early too. So combining, they were bringing about $29,000 a year from Social Security. Unfortunately, they didn't have a pension and they didn't have rental income. So they had that same expense amount of $76,000. So their portfolio had to generate close to $47,000 a year just to keep the lights on. When 2008 hit, they were pulling that $47,000 a year from a portfolio that had dropped to about $830,000. That's a 6% withdrawal rate. And they were making those withdrawals while the market was still down. So every year through the recovery, pulling the portfolio never gets enough traction. By 2022, they had about $480,000 left. Dennis was 79. He said, we did everything right. We saved for 30 years. We didn't panic and sell in 2008. We just kept living our lives. And he was right. They hadn't done anything wrong. The plan just had a structural problem that nobody had caught before they retired. It was the same market. It was the same crashes, unfortunately, the same starting point. One couple ends up with 2.4 million, the other with $480,000, and they're generally scared. That's not the market. That's just one decision made before retirement. So practically, what do you do with this? Well, first of all, you start with an inventory of your guaranteed income. You add up your Social Security, any pension, any rental income, or any guaranteed annuity income you might have. You add those up and you compare them to what actually you need to spend in retirement for your basics. So that gap between what's guaranteed and what you need is the number that matters more than any of your portfolio balances. For Margaret and Bill, their gap on $1.5 million was about $12,000 a year. So less than 1% withdrawal rate. That's why they never had to sell in 2008. For Dennis and Carol, the gap was $47,000 a year on $1.45 million. That's the same starting balance, completely different exposure to a bad sequence of years. So if your gap is significant, the question is whether you can close it before you retire. See, Social Security timing is also a big lever for most families. For a married couple with full careers, the difference between claiming early and waiting can be $400,000 to $600,000 in lifetime income. You see, that's a lot of dough. And unlike portfolio returns, it's guaranteed. It adjusts for inflation, and it can never go to zero in a downturn. You also want to make sure the portfolio is positioned to match the income plan. If your income floor covers most of your expenses, your portfolio can afford to grow aggressively, but it's never going to be forced to sell at the wrong moment. You know, the families that I sit across from often have never coordinated or connected these two conversations. And I've been doing this for 31 years, and this is the part that I think most families unfortunately don't find out until it's too late. You see, building an income floor, it requires decisions that need to be coordinated years before you retire. You need to think about how to time your Social Security. And those decisions touch your tax bracket, your Medicare premium, your Roth conversions. It also affects your advisors, your CPA, your estate attorney, your financial advisor all at once. And in most cases, these advisors have never had a single conversation about your situation together. Not one. Your CPA is doing your taxes. Typically, they're looking backwards. Your advisor is managing your portfolio, and your estate attorney drafted your documents and moved on. So nobody's actually looking at the whole picture. You see, I'm sort of a weirdo. I actually look at all of it at once. I read the actual documents. And the fact is, most advisors don't do that. And what I find consistently is that when those pieces aren't coordinated, families leave enormous amounts of money on the table. Not from bad decisions, but from disconnected ones. Dennis said something I still think about once in a while. He said, I've had 3 different people give me 3 different pieces of advice, and nobody ever told me how they fit together. You see, that's the problem. That's the problem with having advisors that don't talk and that don't look at the whole picture. And the retirees who sleep well through the crashes and through recessions and through the years of war and inflation and headlines and all those things are generally scary. Almost all of them built an income floor before they needed it. Not as an afterthought, but it's actually the first decision they made in retirement. Margaret and Bill, they didn't do anything miraculous. They just had a plan where the pieces fit together. Bill had a pension he earned over 30 years. They waited long enough to claim Social Security. And because of those two things, their portfolio never had to carry the weight of their lifestyle. Dennis and Carol weren't reckless. They were just one decision short, and nobody caught it before they signed the papers. If you want to figure out whether you're on track to be Margaret and Bill, or you've got a complicated picture and you want someone to look at the whole thing at once, I'd love to chat. The link is below. There's no pressure. It's just a conversation. I hope this was helpful. I really like making these videos, and I'll see you on the next.